We got off to a bit of a sour start in this holiday shortened week with the S&P 500 down about 0.5% today. We continue to see a little bit of outperformance out of the NASDAQ-oriented areas, especially companies like NVIDIA and Tesla managed to close nicely higher today. But other sectors really fell by the wayside, including energy, which was down over 3% here today. We did have a challenging day for commodities in general due to the rising dollar. That also led to underperformance of foreign stocks versus US-based stocks. So we'll talk about all that tonight, see what it means for our posture. We'll then get into our trade application example, where I wanted to focus on a tech stock that is still trading below its 3-month highs, unlike the sector itself that were established back in March. And it looks like it is poised to continue underperforming, so I thought we would do a bear call spread. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's June 20th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list. That way you can be notified whenever we post these videos. Also, at the bottom of those emails, you'll find which stocks are giving you overbought and oversold cluster signals within the S&P 500. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook posts. And then last but not least, we do have a presence on Facebook. Feel free to join the group you see listed in the logo in front of you. All right, let's go ahead and jump into today's trade activity. As you can see, I've got the S&P 500 pulled up here. Looks like a little bit of a hangover from the holiday weekend. Hello to those of you that I missed last week. I realize sometimes when I do the video on Thursday, I forget about the holidays coming up. So for those of you that celebrated either Juneteenth or Father's Day, I hope you enjoyed your weekend and hopefully got some nice time spent with family and friends, maybe some grilling out, enjoying the weather, all that kind of good stuff. But as we kind of kick back into gear here with the stock market in the United States this week here on Tuesday, we didn't really start things off on the right foot. Reminder as well that Friday happened to be the June monthly expiration date for options, and so sometimes we have a little bit of a pivot after that's all sorted away, and who knows, maybe this expiration cycle we get a little bit more selling and bearishness than we've been used to here in recent cycles, where we've had it pretty well for the most part in the US stock market in 2023. In fact, it's one of the top, I think they said top 10 starts to the year as they've recorded this data throughout time. Of course, a lot of that being driven by those themes that we've talked about endlessly in these videos, mostly the AI-fueled themes driven by things like NVIDIA. And speaking of which, a good segue, because you can see one of the stocks that managed to go up yet again today was NVIDIA. I mentioned in the last video that I did that we had the good fortune of doubling our money in that one, and therefore we were able to sell half of our shares and play with the house's money on the rest. And guess what it's done since then? It just kept on going up. So, of course, you'll always second guess yourself and wonder whether you should have kept all the shares or, that game can be played endlessly. But what we do know is we've got our money back in our pocket and we've got some free shares out there. And if they do continue to rocket higher, then our top-down trend trading class will be pretty enthusiastic about that. So one of the winners here today was NVIDIA. That has been kind of the talk of the town in the U.S. stock market here in 2023, up another 2.6% today. Not to be outdone, Tesla had a really strong day as well. Tesla was up 5.34% here today. Now remember, oddly enough, NVIDIA is bigger than Tesla right now. I think a lot of people are surprised to learn that. But Tesla had quite the give back last year, like so many tech stocks, and in this case, a discretionary stock that leans tech oriented. And Tesla has been on an incredible run here in the last, let's call it, month or so. Remember, they weren't necessarily participating all the way along the upside the way that some other other stocks were in the full calendar year of 2023 that we've seen so far. Theirs has been more of a recent phenomenon, but boy, oh boy, the consistency of the upside in Tesla has been breathtaking. And today, boy, did they cap it off with an amazing 5% day on a day when the market itself kind of struggled. We were down about 0.5% here today. You'll also see that Amazon managed to close in the green, although not particularly noteworthy, simply just up 0.23%. That was kind of the story with Apple as well. It was just barely up 0.05%, but take a look at that market cap there. Apple now has a $2.9 trillion market cap. They are not that far away from being the first company in history with a $3 trillion market cap. Other big players that managed to close in the green today, we did have Meta, the old Facebook. It was up over 1% today. Netflix has been on a pretty nice run. It's up 0.2, sorry about that. It was actually 0.63% today. Salesforce.com, remember that company probably doesn't get the publicity as some of those others that we've reviewed already, but they are one of the rare tech stocks in the Dow Jones Industrial Average. And so that helped maybe that index a little bit more so here today as it was up about 2.5%. We got some snapback out of some of those health insurers. Remember last week we had a day where a lot of those health insurers really got hit hard, but they've been snapping back a little bit since that initial day. United Healthcare was up another 2.38% today. In fact, we had a question about that in my Thursday Q&A class. For those of you that are premium members, feel free to check that out. We also saw that Merck and Eli Lilly both managed to close higher, up almost 1% in each of those cases. And then let's just have a quick little note about PayPal, because while it's not a $100 billion plus type of company like a lot of those others, it is at $76 billion from a market cap perspective, which is still quite noteworthy. And it managed to be up about 3.7% today, so pretty strong day there. Eaton was up 1.5%. That's one of the stocks we also own in our top-down trend trading class, where we also own NVIDIA and Microsoft and Alphabet and some of those. So Eaton's kind of been lumped into some of those AI-related themes lately, as well as they kind of help folks out with the data centers and the automation and different things like that go into that is a requirement for some of the AI-related activities. So anyway, there were a handful of names out there that managed to close in the green. But as you can see, today's story was a bearish story, mostly in the red. You had a handful of exceptions to that, but for the most part, if you threw your dart at the market today, pretty good chance you ended up with a losing stock. Some of the ones that kind of stand out a little bit more to my eye, Boeing stands out, down 3.5%. I think they just had a big air show here over the past week or so, so maybe the orders didn't come in as good as what was expected. We saw that Warner Brothers Discovery was down about 5% today. Oracle had a tough day, down 2.7%. Remember what I mentioned last week, that Larry Ellison, I think he moved up to the number 4 position in terms of the world's richest people. He had surpassed Jeff Bezos and a number of the Microsoft executives and different things like that. So sometimes we don't talk about Larry Ellison the same way we talk about Elon Musk and Warren Buffett and Jeff Bezos and the like, but he's right up there in terms of wealthiest individuals on the planet. Oracle had been on quite an incredible run. It's a $330 billion company these days, but gave some of that back here today. I also noticed that Nike was down quite a bit. Remember, Nike is a company that's in the Dow Jones, so it's going to have a little bit of an impact there. They were down about 3.5%. Some of you might have watched that movie Air here a month or so back. Actually watched it in the theater and then watched it again once it was released on Netflix. A great movie, especially for those of you that grew up in my era. I grew up in the 80s and 90s when Michael Jordan was all the rage, and so that movie Air was about how Nike was kind of trying to sign him and working with the family and all this kind of stuff with Matt Damon and Ben Affleck and others. So for those of you that are sneakerheads out there, or just enjoy Nike or Michael Jordan or that era, I think you'll get a kick out of that movie. I certainly enjoyed it myself, but they struggled here a bit today. You can see that energy seems to be on the outs here today. Exxon, Chevron, Conoco, EOG, all of those were down somewhere between 2 and 3%. So looks like there was maybe only one energy stock that managed to close in the green, and that was Williams Company. So wouldn't be surprised if that was our worst performing sector here today when it all shakes out. So a lot of the financials down as well. I think I heard on CNBC earlier today that a lot of the banks that had a pretty decent run here in the last month or so were giving back a number of those gains here today. So, Bank of America, JP Morgan, Citigroup, PNC, Huntington, Regions, M&T, Truist, all of those kind of gave back some gains here today as well. So all in all, it was definitely one that is a day to forget as we kick off this holiday shortened week. One of the rare days where the Bears have convincingly won the day. We've seen much more often be the case here earlier in 2023 where the Bulls were the ones that were winning the day. Speaking of Michael Jordan and the Bulls back in the day. Usually in 2023 we've seen the stock market bulls out running wild, but today definitely towards the bearish tilt here today. Let's see what the exact numbers are by taking a look over here on the MarketWatch Visualize area of the Thinkorswim platform. For those of you that are premium members, be aware that I did update, I think it was 5 of our customized charts here over the weekend. I did send out a Telegram note in our private channel yesterday about that, but in case you weren't on there or didn't happen to see the note come through, just be aware that I did do an update on a number of our Thinkorswim charts. Most of them are those that start with the number 1, and so in other words, they're charts that would be associated with my Monday morning top-down trend trading class. So if you don't attend that class, no worries at all. It's probably not worth your effort to go through the updates, but if you do attend that Monday morning class, make sure you do import the new shared links. Normally, I'm not going to make a big deal out of that, but in this case, it is noteworthy because without the newest importable shared links, those charts will no longer work because there were some ticker symbol changes and different things going on. We had kind of talked about that last Thursday in this presentation as well. But anyway, the charts have officially been updated, so make sure you put that on your to-do list if you happen to attend my Monday morning top-down trend trading class. Anyway, back over here to the MarketWatch Visualize area of Thinkorswim, you can see that just 96 stocks managed to close higher here today. So that's only about 19% of the index closing in the green. Over 80% of the market was down today. And I know that to be true personally as well. It's been a tough year for dividend investors, which is what I fancy myself. And today I noticed in my Roth, almost all of my stocks were down. And I don't just have like 5 or 10 stocks in there. I have dozens, and nearly all of them were down today. So if you look at your portfolio and you're seeing that you're experiencing the same thing, you're not alone. Misery loves company, I suppose, is the old saying. So tough day for stocks in general. Handful of companies that managed to avoid the selling, but for the most part, the path of least resistance today was most assuredly to the downside of the market. All right, let's go ahead and now take a look at our 4 grid here. This is chart 4B for those of you that are premium members following along at home. And as I mentioned here a moment ago, it was a day for the bears. All 4 of these charts do show selling here today, but you'll also notice that despite today's selling and also Friday's selling, we still have strongly bullish postures across the board. So let's go through the information, see what we can glean. So the S&P 500 was down 0.47% today, so about 0.5% there. You'll notice that we did close with what's known as a bullish intermediate confirmation signal. That occurs when the green line is considered bullish. And remember, the green line is considered bullish anytime it's in the upper reversal zone, as it is right now, or traveling between the lower reversal zone and the upper reversal zone heading higher, like it kind of would have been back here during this March time period. So however you slice it, you do need the green line to be considered bullish, and that is the case right now. Now that needs to be teamed up with the red line, the momentum line, in the lower reversal zone on that particular day of the signal. Now on this one, it can't just simply be traveling lower between the upper reversal zone and the lower reversal zone. Here, in order to have an official signal, you do need it in the lower reversal zone. And this one, just by the slimmest of margins, was able to get that accomplished. Notice that the red label right here can help us see that, even if you're on a smaller screen that you're watching this video on. Just look at the label, and today's reading on the momentum line was 19.45, so that was below 20.00 by a very small margin. Nonetheless, it would qualify. The other nice thing is, although the blue line is technically not part of that bullish intermediate confirmation signal, we do like to see it when the blue line is between 50 and 20, and that was the case here today. Again, just barely, but it does go to show that there has been a little bit of a pullback off the highs that we experienced intraday there on Friday. Not only did we close lower on Friday, but then we ended up closing lower again today. Now, I don't know how much this is the buy the dip signal, which is typically what you're using that signal for, simply because we are still way, way, way above that rising 30-day moving average. So it doesn't strike me as one that you're getting an immense discount on the merchandise. Nonetheless, after we had previously seen 1, 2, 3, 4, 5, 6 days in a row to the upside, even a rather small 2-day pullback is a little bit of a buy the dips for people who have been just waiting for any sort of selling to take place. You'll notice that the Dow has the same thing. Now, the Dow was down a little bit more today. It was down 0.72%. And you'll notice that the green line remains in the upper reversal zone above 80 at the moment. The red line did manage to close below 20. This one was at 17.13. And same thing, the blue line, although not technically part of the official signal, helps us kind of separate the wheat from the chaff a little bit. And you'll see here the blue line was between 50 and 20, where we like to see it at 42. So again, a little bit more of a buy the dip signal there. Similar conversation with the Dow, where you had a new multi-month intraday high. In fact, I think that might have been a yearly high as well, not just months, but over a year on Friday. That ultimately resulted in us closing basically at the lows of the day on Friday, and then a follow through to the downside here today. This one you can see is a little bit closer to the 30-day moving average, so maybe you could justify getting a little bit more excited about this signal here without as much fear that you're going to have a big breakdown. Then again, you could also kind of argue the opposite side of the coin and say, well, we did see the Dow Jones break below that moving average without much difficulty the last time around, whereas the S&P 500 was much more resilient around that point. And of course, the difference between those two largely is the AI theme. NVIDIA is not part of the Dow, but it is a big chunk of the S&P 500 and similar companies like it. You could say the same thing with Tesla as an example, not in the Dow, but in the S&P 500. So those types of companies are the ones that have really supported this market the most here recently, and you don't find them in the Dow quite as much. So debatable as to whether, which one is the better setup, but just to be on record about it, the bullish intermediate confirmation signal does exist on both of those top two charts there. The bottom two just narrowly missed it by very, very small margins. Notice the NASDAQ Composites red line is at 25 right now, so very close to 20, but not down below it. And then the Russell 2000 was even closer, where it was down today as well, but at 20.73. So if that would have been 19.99, then it would have qualified just like the upper two did, but it didn't quite do it today. Maybe tomorrow, right? Sometimes we're due for a third straight sell-off day, and maybe that'll be the day where the signal shows up on the Russell 2000 and perhaps even the NASDAQ. We shall see. But what we do know is that, once again, the NASDAQ was the day's leader. Notice that it was down today, so it didn't manage to avoid that fate. However, I will say in the final hour of trading, the NASDAQ was positive for a brief amount of time. It didn't quite close there, but it gave you the sense that it wanted to make the attempt. And of course, Tesla and NVIDIA rocking it as much as they were today, that's going to have the biggest impact on the NASDAQ Composite compared to all of these other three charts. Tesla and NVIDIA, as I mentioned before, are not part of the Dow Jones. Tesla and NVIDIA are not part of the Russell 2000. They are part of the S&P 500, but they're not going to have as big of an impact on that index. So the NASDAQ is where you're going to get kind of that more pure tech-driven phenomenon. And so the NASDAQ managed to avoid a major sell-off today by selling off by just 0.16%. And it was the day's relative leader here. And as I mentioned before, it just barely missed having one of those bullish intermediate confirmation signals. Notice on all four of these charts, the green moving average suggests that price is still above rising moving averages. Remember, those are still bullish features, all else being equal. So we remain in a very bullish territory for these markets at the moment. Some of you might have caught my tweet on Friday as well, where I wanted to kind of add supporting evidence to the idea of improving and broadening market breadth. Maybe I could even pull up the tweet in question here if I can find it real quick. I wasn't prepared to talk about this right now, but usually I can find these pretty quick. So give me a second, because it might be useful for some of you that don't follow me on Twitter. Where did it go? There it is. I mentioned that there were 136 out of the 1,000 stocks that we have in our Market Scholars 1,000 list that hit a 52-week high this past week. So this was on Friday when I mentioned this. I said that is the highest weekly number since January 7th of 2022, not 23. So we're talking about basically the best market breadth here that I've witnessed through just the lens of new highs versus new lows in my subset of stocks in a year and a half. So that's another feather in the hat for strengthening market breadth, right? And here's kind of what this looks like a little bit closer for those of you that want to see it. But 136 stocks hitting new highs, only 13 hitting lows out of that group of 1,000. Remember, there's no ETFs, there's no closed-end funds, there's no bond funds, right? Sometimes when you're tracking new highs, new lows on something like the New York Stock Exchange, you muddy the waters a little bit there. And so I kind of like to apply it to a direct index. In this case, not technically an index. It's just a group of stocks that we track here at Market Scholars. But the point is there's 1,000 stocks and only stocks. And from that vantage point, we did see the highest amount of new highs. Over a tenth of that group of companies were hitting 52-week highs last week, and the last time we had such a sizable amount was a year and a half ago. So that's yet another, as I mentioned, feather in the hat for strengthening market breadth there. This is not just a 7-stock story, as sometimes people might want you to believe. There is a broadening out that's taking place. It's not the most extreme I've ever seen, so some of you might be wondering, because you're not used to following those types of statistics, is that like unheard of type of territory? No, it's not. We've seen much more aggressive weeks than that if we go back several years. Nonetheless, it is at least important for us to, recognize and reflect upon, because there are a lot of people out there that think this is only a tech-driven rally, and that's really not the case. It might have been the case, let's say, 2 months ago, but it's not really the case right now. We are seeing that broaden out to a much bigger group of companies that are out there, and that's usually a healthy sign for the markets. And so we'll take what we can get as bulls, of course, after a tough year last year, one of the rare down years that the market has seen in the last dozen or so years. So anyway, good to see the snapback from the bulls here in 2023 so far. But again, bullish conditions with bullish intermediate postures on all four of these charts. All four of these have upward trending 30-day moving averages that prices are above, and 2 out of the 4 charts, the Dow and the S&P 500, ended today with a bullish intermediate confirmation signal. And by the way, if I didn't mention it specifically, the Russell 2000 was down about 0.47% today, so it basically matched exactly what the result was on the S&P 500 today. I would say that the chart looks a little different to me. You look at the S&P 500, there's definitely a stronger bullish push behind what we're witnessing right now. Whereas with the Russell 2000, it was a little bit of an oddball situation where you had this incredible 4 out of 5 day rally. And we talked about that. I brought it up last time I was with you last week, and we were talking about it as it was happening. That was truly extraordinary. This candle, this candle, and this candle, with that middle one being the only down day in the group, but the other 4 being really phenomenal types of days. So we went straight up during that 1 week period of time, and since then we've basically gone sideways. This one's kind of hard to interpret where we ended on the Russell 2000 today. On the one hand, so let me kind of zoom in here. On the one hand, you could say that, well, we closed near the lows of this last, let's call it week and a half type of a range right here. And the only closeout we had on a daily basis along that specific time period was this candle right here. It was a little bit lower on the close than this one, I think. Let me just double check that. 1865, yeah, just by the slimmest of margins. This candle here closed 1 point lower than what it closed today. But you will notice that we breached those levels on an intraday basis today. So when you see a candle that looks like this, it's not just this red rectangle up at the top that you want to consider. It's also this thin line below it, because that shows you where the company traded throughout the day. It didn't necessarily end in those areas and close in those areas, but it did trade in those areas on an intraday basis. So it did break down through some perhaps important support area on an intraday basis. But the other thing to consider is sometimes when we have a group of candles that look like this actually ends up being a positive thing for the market. You could say that it was a hammer if it is formed at a support area. And that's why I mentioned a moment ago, it's hard for me to interpret this one. And remember, life's not quite as easy as what it might make it seem like in a textbook where you have the perfect example. Because here you could argue it either way. Is this support or is it resistance? Well, kind of depends on what you probably want to have happen to the market. Those of you that are bullish would say, yeah, this thing is basically sitting right on this horizontal support area where it refused to go through for the last week and a half. And today you were still able to close above that range, even though you tested it to the downside on an intraday basis. Others would say, well, what are you looking at? That's got to be resistance. This area is way higher on the chart than a lot of these other areas back here. So you can see that oftentimes in the world of technical analysis, it's in the eye of the beholder. So we'll find out. But remember, even if you are in the camp that this was support here, where you got this candle that looks like a hammer, you would need a follow-through day the following day to confirm it. So you don't want to just kind of roll the dice and say, yes, I'm going to claim that this was a hammer. Usually you don't recognize it until the following day when the market basically proves your point that you're trying to prove through price action. So we'll find out tomorrow whether that's a possibility, but it is a little more challenging just because of where it's placed to determine, is this support or is it resistance? From kind of an intermediate time period perspective, you could probably say it's still resistance. From a short-term perspective, in the last week and a half, you could probably say it's support. So the market will do whatever it needs to do to figure that out here tomorrow. But just be aware that we did cut through on an intraday basis some of that prior range that we've been dealing with here in the last week and a half or so. So anyway, I found that to be somewhat interesting there as well. But back to the 4-grid view, all those charts still look like their path of least resistance is to the upside, not to the downside. And if that changes, we'll be more than happy to share those thoughts with you if and when that does occur. Let's also take a quick peek here at our 3 green arrows chart. So this will be chart 4D for those of you following along at home. And you can see here that we did lose the 3 green arrows status on one of these charts, and that was in the lower right-hand corner here. This is the Russell 2000. Notice we did get a red arrow to show up on the MACD histogram. Remember, that's how we judge momentum. So we did have a loss of momentum, and again, based upon what I just got done sharing with you there a moment ago, I think that makes sense in my head, right? You look at the S&P 500, and you see that it still has plenty of momentum. You look at the Russell 2000, you see a different looking chart where you had basically all of the move made in these 4 days, and then you've basically just gone sideways. So that is a loss of momentum taking place right there, and that's what is being identified with that red arrow in the MACD histogram. With all of the other charts, you have retained all 3 of the green arrows, whether it's the moving average, the MACD, or the stochastics. So not a whole lot of fear yet in those other areas, but of course, anything can happen. I think I heard that that Jerome Powell will be speaking to might be Congress, I'm not sure, somewhere in D.C. He's scheduled to speak here, I believe, tomorrow. So I don't know if that'll have the possibility of impacting the markets, but it could, right? And we just never know. So we'll keep our eyes on it. But right now, it's not anything to get too wrapped up into. The trends remain to the upside for the most part, but just be aware Russell 2000 did have just a slight give back there, and now is dealing with 2 green arrows and 1 red arrow. And then let's take a look here at a longer term perspective as well. This is the 1040 crossover method here. And as you can see, things look pretty good here as well. We have 3 out of these 4 charts that have what we refer to as golden crosses. And remember, in these charts, we're using weekly candles. So as opposed to the typical 50, 200-day moving averages that you might hear other people using, we're using the equivalent of that on a weekly chart basis. So it's the 10-week moving average versus the 40-week moving average. Remember, if you just take those times 5, it's the same thing as the dailies because there's typically 5 trading days in a week. So 5 times 10, of course, is 50. And that's where other people using daily charts will use the 50-day moving average. In our case, if we use the 10-week moving average, it effectively is the same thing. But the benefit here is that it gives us a chance to look back a lot further in time without scrunching the candles up too much. So when we're looking at these charts, each one of these 4 charts you see in front of you is 3 years in length. Each one of the candles is 1 full week in time. And so we do have bullish crossovers or golden crosses on the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite. But we're not quite there on the Russell 2000 yet. It's got to be getting close. So let me zoom in here, maximize on the Russell 2000. You can see where we're at right now is nearly touching, right? This background color will change to green once this orange line is officially up and over the blue line. So the orange line is the 10-week moving average. The blue line is the 40-week moving average. And we are just by the smallest of margins just below that. So if we have a bullish end to this week, it is possible that the Russell 2000 joins the other 3 with golden crosses. On the other hand, if today is a bad omen and a sign of selling to come, then maybe, just maybe, the bears will be saved on the Russell 2000. Not that that's going to control all activity, but generally speaking, when markets get clicking in either the up or the down direction, you kind of want all of them working together. And we have had a really nice move out of the Russell 2000 here over the last, let's call it, a month or 2, with much of it happening in that 4 out of 5 day window that I had mentioned before. So it has been lagging from an intermediate perspective, but it's got a real good chance of joining the other 3 here sooner rather than later. The path of least resistance is likely for that crossover to occur. Right now it's still stuck with what we would refer to as that death cross. All right, let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these presentations. They do take quite a big effort out of David and I, and we do want to, of course, share our knowledge and our passion of teaching and investing and all that to our audience. But you also have to remember, we're already doing that throughout the day, so we don't need to do it again on YouTube. Those of you that did not join me earlier today and you're a premium member, remember I do have the class for dividend growth investing now posted on our website if you want to check out that recording. Today we did focus on the technology sector in our head-to-head matchup. Anyway, I always like to get a chance to say thank you to our most loyal fans out there. As I always say, as long as we're up and over 100 likes, I'm more than happy to give you a full-length video the next time I'm scheduled to do it. Remember, I do it on Tuesdays and Thursdays. If we're under 100 likes, then I'll plan on just sticking to a very short and sweet 15-minute version. So if you like the longer form versions with the extra 12 grid analysis and trade application examples, get in the habit of clicking like and joining the 100 others that are helping support it. On the other hand, if you kind of get the opinion that these are getting a little bit long in the tooth and you prefer just to have a quick hitter and just talk about the 4 main indices and not about all these other stocks and stuff, then don't click like. And if a lot more of you don't click like, then we'll just keep it short and sweet. So anyway, let's do some shout outs here. I always enjoy this part because I like to see who's our most loyal followers that are out there. So some of these are definitely of that billing. So thank you to Scott and to Sandeep and to Serene and Rich and Roger and Marty and BZ Japan and Jim and Tom and Eugene and HR and Austin and Fred and Philip and Pam and Ron and Kirk and Ryan and Dave and Paul and Leo and Ash and Chloe and David and Ayakipa and Fathy and H. Patel and Terry and Brandon and Kenneth and Jonathan and Renee and Ann and Ken and Greg and Rick and Craig and Richie. The list goes on and on and on. Can't get to all of it, would chew up too much time, but every so often I think it's fun for you guys to see your own name in the lights, so to speak, there, and just a small way for me to acknowledge you and say thank you for helping support us. That does mean a lot. We really appreciate it. Let's also have a little chat here about the sector selector. A reminder that this gets put together on Friday nights. Remember, I create it specifically for my Monday morning top-down trend trading class because we use this information to help us place trades. This week, because of Juneteenth, we didn't have the class, but I still produced the tool itself since I wasn't going anywhere this weekend. I was around here, so it was easy enough for me to do it. So for some of you, this might be the first time you're seeing it. In typical weeks, you'd have already seen it on Monday morning. But we didn't really have a lot that changed in the upper echelon. You can see here that technology ruled the roost yet again. This is their 5th straight week in the #1 position. That's where you're going to find your AI-related names like NVIDIA and Microsoft and Apple and some of those semiconductor companies, Synopsys and Broadcom, and some of those have been rocking it lately as well. So information technology continues to lead, not anything new in that regard. In our 2 through 4 position, we did have the same top 4. And remember, in my class, that's what we care about is the top 4 because we think in thirds. We're looking for stocks that are ranked in the top third of all stocks, that belong to sectors in the top third of all sectors, and within industries that are in the top third of all industries. But for sectors, since there's 11 things we're measuring, the closest we can get to a 33% amount is rankings 1, 2, 3, and 4. So those are the ones that give us practical knowledge for that class's purposes when we hold it. And in this case, we continue to have the same exact top 4 that we've had for the last month. If you look, technology was #1 those last 4 weeks. Industrials, which is #2 this week, was #4 the prior week, but #3 the 2 weeks before that. Consumer discretionary has been #3 the last 2 weeks, but was #4 the last 2 weeks prior to that. And then communication services is #4 this week, but was #2 the weeks before that. So in other words, these 4 sectors have been our leaders every single week for the last 4 weeks. It's just that they've occasionally changed positioning within that top 4. So anyway, pretty good day there, or a pretty good view, I should say, not day, but a view of this graphic here, because remember, those are where we get our alpha generating opportunities. This is a lot of risk on types of sectors that are up here, growth oriented sectors, or at least in the case of industrials, more cyclical, that are hinging upon strong economies and things like that. So we like to see it when we're being led higher by that grouping of sectors. And equally as important is what's not working on a relative basis. And you will notice that consumer staples has now fallen to dead last for the first time in at least 3 months. Utilities is second to last, and healthcare is fourth to last. And so those 3 I would identify as defensive sectors. Healthcare is a little bit different because there's kind of elements of both growth and defensiveness in there, depending upon which industry you're looking at within healthcare. Nonetheless, you generally like to see the rotation shake out in this way, where you have more of your defensive areas in the lower half of the rankings, you have more of your growth-oriented areas in the upper half of the rankings. So as I mentioned last week, this is another feather in the hat for the bulls. This is another piece of evidence that suggests that we are in more bullish market conditions here at this moment, and we have been for the last month. This is not like new information. I kind of say the same thing with you guys each week, it feels like, more recently. So just reiterating that we continue to be in a more bullish market environment here based upon what we see from a sector rotation perspective. All right, let's go ahead and now pop back on over to the main part of the platform, and let's do some 12 grid analysis, starting with chart 5A. This is our asset class 12 grid. As we pull this up here, a reminder that the background colors will tell you what the current posture is, whether it's bullish, bearish, or in some cases, neutral. It's very, very rare, by the way, for that to happen, but we have an example of that today, wouldn't you know? And that is the foreign bonds here, kind of in the middle rung, in the middle of the screen there. Notice how its background color is white, and what that identifies is basically the intermediate reading for the intermediate line on the market forecast was exactly the same today as it was the prior trading day, which in this case would have been Friday. But point is, it didn't go up or it didn't go down. It stayed exactly the same. That is very rare, and that's why we hardly ever have this conversation. But it can happen the way that these scripts are developed. If it's white, that's what's happening. It's basically as neutral or flat as a board from a posture perspective as you could possibly get. The other charts have our typical green and pink hues associated with them. Let's start our conversation off in the lower right corner, as we oftentimes do, with the 10-year U.S. Treasury yield. It did slip a bit today, but still remains above a rising 30-day moving average. It continues to have a strongly bullish posture. It's still closer to 3-month highs than 3-month lows. So you could get away with saying we're still in more of a rising rate environment here at the moment, at least judging by this kind of longer term yield of the 10-year. We ended today at 3.72. Again, it was down today, but because it's been doing so well recently, you get a little bit of flexibility there where you can give back some gains but not give up the posture itself. So right now, a rare down day, but remains with a strongly bullish posture above the rising moving average. Remember, when yields are down, as they were today, more often than not, bond prices are up. And that's especially true when it comes to U.S. government bonds. And you can see here, TLT, our proxy for long-term U.S. Treasury bonds, was up 0.69%. Now notice here, we're back above the moving average. And by the way, that trade is now done. Remember that with June being Friday being June's expiration for options, we did have an iron condor that was closed successfully at 100% max gain there on TLT. So for those of you that are wondering, I no longer have an open position on that because that did expire at max gain on Friday. And so there were a couple other trades I did have to shut down, and some of them didn't do nearly as well. So you're going to have some hits and your misses along the way, but I wasn't happy to see, at least in this kind of macro chart of U.S. government bonds, we didn't scare ourselves out of the trade when TLT started to rip lower here pretty aggressively to have all these oversold cluster signals, and that ultimately responded with a reversion to the mean type of a move, which really benefits a trade like an iron condor that wins you money when conditions are more neutral. So it was nice to see that. But this has actually been reasonably impressive here the last 3 trading days, because TLT is clearly above its moving average right now. Remember, we attempted to get above the moving average right there on June 1st. We also attempted to get above it right there on May 11th, but both of those times failed. So it was good to see that this time around, we appear to have a little bit more resilience there. And whether that continues or not is anybody's guess, but right now we at least have to give it the benefit of the doubt. Whereas if it would have failed right there like the prior ones, then we probably would have had our hesitations. But right now it's kind of giving you the impression that it might want to make a move. So let's at least keep our eyes on it and open our minds to that possibility here. Foreign bonds were up today. They were up 0.25%, not a huge move, but as I mentioned before, neutral posture, and that makes sense. You look at this chart, it's basically as flat as a board, right? That is sideways price activity there for foreign bonds. Notice that high yield bonds actually closed lower today. Remember, high yield bonds are sometimes a reflection on risk appetite. And with the stock market being down today, sometimes that pressures the riskiest corners of the bond market, aka the junk bonds. There's also an element of energy exposure in junk bonds in this current era. And you'll notice down below, oil prices were lower here today. So that might have had a little bit of an impact there as well. So despite falling 10-year Treasury yields, junk bonds also fell today, whereas the other 2 bond categories government bonds in the U.S. and foreign bonds both managed to close a bit higher here today, as kind of it was a little bit of a risk-off type of a day. It wasn't a huge deal, but some of that rip-roaring, wild stock trading to the upside that had been commonplace here in recent weeks kind of took a little bit of a day off. And sometimes it's days like that where money can rotate back into the perceived safety of the bond market. You'll notice that one stock, or not one stock, but one chart that's really taken off here recently is Bitcoin. We've been kind of waiting for a move like this, right? And it's probably bored some people to tears in waiting for it, but ever since this area here, basically the first week of May, we've been kind of just grinding lower on Bitcoin for that entire time. So we're talking about a month and a half where it's basically gone down, but not aggressively, right? A lot of times you're going to see a lot more aggressive sell-off with Bitcoin. So we didn't really see that this time. It was just kind of like languishing. On the other hand, what was also peculiar about it is, remember, that was at a time when risk appetite was high. And oftentimes Bitcoin and risk appetite go hand in hand, but this time around it didn't really shake out that way. But you can see how quickly that can get corrected. And in the last 2 days here for Bitcoin, we've basically just gone straight up. And now we're way above that moving average once again. You'll notice that we're at 28,000 on Bitcoin. Remember, just last week we were below 27,000. And you'll notice that we now have that light green background color saying that we have a weekly bullish posture. And you even have a change in the moving average. Moving average is still going lower, but price is now above it. So that's why we have the moving average change from red to yellow in this case. So, it's a start. Does the chart look great? No, it doesn't. But we know that this is the type of asset class that once it gets cooking, it can get cooking very, very quickly. It's not the type of thing that just is a yawner type of a thing, right? You usually have more aggressive trading within that cryptocurrency universe. On the lower left-hand corner, you see that the US dollar was up today. That still hasn't let it get back above the moving average, however. It was at one point on an intraday basis, it just didn't close there today. So anyway, it's making an effort to stabilize here. We'll see what tomorrow brings, but today was actually a pretty decent day for it, up 0.28%. Not good enough to get us back above the moving average, however, and still not good enough to change the posture back to bullish. Gold was down today, as I mentioned before, oil. Remember, when the dollar is up, typically you're going to find commodities struggling. And that was the case with gold really going down to 3-month lows. That was kind of interesting as well. Notice that today's close on gold, let me zoom in here so you can see this a little bit better. Today's close on gold was below this candle back here on May 21st. So this is not like new information. I'm just, again, reiterating what we've already known. For a while, gold looked really strong earlier this year. But since this period of time where we had this really aggressive breakdown below the moving average back here on May 16th, this thing just can't get out of its own way. It's grinding its way to the downside at the moment. So there's just been better places to be. Again, gold's one of those asset classes that just doesn't always get a starring role in the movie when risk appetite is high, right? There's a lot more excitement when the starring role of the movie is Nvidia or Tesla. Who needs gold when you've got those types of superstar stocks out there just racing to the upside? So they've been kind of languishing here a little bit as well. And then oil was down 0.67% today, but despite that being down, unlike gold, which has a strongly bearish posture, oil actually has a strongly bullish posture right now. But I will say the same thing on oil that I've been saying for probably the last month or so, which is regardless of what the posture is, just the look of and the shape of the chart suggests that we don't have much in the way of directionality right now. Oil is kind of listless. It's looking for direction. It doesn't know where it's going to rock from one week to the next. So right now you got a little bit of a bounce, but we could very well be back to strongly bearish posture 2 days from right now, for all I know, right? So this is still one where we're kind of in a holding pattern here, whereas it's more decidedly bearish with gold at the moment. Remember, another thing that tends to happen when the U.S. dollar is strong as it was today is that foreign stocks underperform U.S. stocks, and that did happen today as well. EFA was down 1.32% today. EEM was down 1.96% today. Both of those were more aggressive sell-offs than we saw in the S&P 500, which is down just about 0.5% here today. You'll also notice that foreign bonds did not do as well as U.S. bonds today, and sometimes that has a role there currency-wise as well. But anyway, these were some pretty big givebacks in the foreign stock markets, right? If you look at EEM, that's a pretty massive move right there. I imagine a lot of that is China-related. I know we've had some officials going back and forth, even business executives and others starting to open up that conversation with China again, but there's maybe been some disappointing economic data coming out of there that's affected publicly held share prices. EFA, notice it's now back below a falling moving average. So while it retains the strongly bullish posture, it has a red moving average. That's a pretty rare combination. You usually do not see it shake out that way. You oftentimes see weekly bullish posture or the light green background color. This is a fairly rare example where you're back below a falling moving average, yet the posture setting mechanism of the market the market forecast is still strongly bullish. So we'll see if that leads anywhere. But another thing to be aware of with EFA, again, these are the developed foreign stock markets. So think of like Japan, Australia, Europe, and what have you. But notice that where we were at on Friday was right up here at a resistance point that was formed on May 5th and 8th. So that must have been a Friday-Monday combo right there. But we were not able to get up and over that area on Friday. And then today, you're just, hit, pretty hard back below the moving average all of a sudden. So not a great look there. You don't want to, give up on it because it did have a really strong move off of its lows here on May 31st. Nonetheless, if you were about to sense a big rotation out of the U.S. into the foreign markets, which a lot of people have been calling for a long time now, you don't typically want to see it start in this way. You will notice that you had a little bit of a bearish near-term divergence on it last week, where you had this blue peak right here and this follow-up blue peak right here that was lower. The two candles associated with that are this one and this one, so price went up when the indicator itself was weakening, and then that led to today's big give back there on EFA. So that one doesn't look so hot at the moment. It's not so far out of favor that it can't be rectified, so I don't want to give that impression, but that's not what you want to see when it approaches resistance. You want to see it blast right through that with a lot of strength, a lot of power, and it got rejected in a big way. EEM, despite how ugly today's candle was, chart-wise over the last 3 months, it's still kind of in the realm of that possibility of, higher highs and higher lows, a strong uptrend type of a thing, right? You still see that the moving average on EEM is still green, as just one example. The other thing I would point out about EEM, and these are the emerging markets for those of you that aren't familiar with that terminology, so think about China and India, Brazil, Mexico, that sort of thing. Notice where we came down to today. While this was a huge air pocket right here, remember a lot of those foreign markets were open yesterday on Monday, even though the U.S. was not. So that's going to play a role when they open up the foreign ETFs in the U.S. markets. They're reacting to what would have already been happening in some of those local markets yesterday. So don't let that scare you too much there. But anyway, what I wanted to show you here is where we found some stability today was exactly where we had resistance over here on April 13th and April 18th. And you've probably heard that concept of breakout retest, right? And we had quite the breakout here in EEM, where we had 6 days in a row to the upside, starting here on June 8th and ending here on June 15th. And during the midst of that 6-day rally was when we broke out above this resistance area over here. So that was the breakout. Today's the retest, breakout retest. Oftentimes you find some stability at around that area as it becomes a battleground zone between bulls and bears. Whether that happens in this case or not, I don't know, but I thought it was at least worth pointing out. The other thing I would point out is that you do have a a bullish intermediate confirmation signal here, just like we do on the S&P 500. In fact, this one's probably more interesting in my eyes, because you've got the green line in the upper reversal zone, you've got the red line in the lower reversal zone, you've got the blue line in that more idealized area between 50 and 20, but this looks like an actual dip, right? The whole point of having the bullish intermediate confirmation signal is to identify a buy the dips moment, right? You're trying to say, well, the green line is telling us that the trend is still strong. The red line is telling us that we are momentarily out of favor. So you want to buy a stock or an index or an ETF when it's momentarily out of favor, but still within the uptrend. And that's kind of how I view EEM, but why this one seems a little bit more interesting to me than on SPY is because this is actually a healthy give back here, right? When we look at SPY, yeah, the signal's there by the slimmest of margins, but that's not a huge give back in that 2-day sell-off right there. Whereas with EEM, you could say that that is a pretty massive give back there in just 2 days. So it makes you feel like you're kind of rifling through the clearance aisle a little bit more here on EEM than on the US market. Let's take a look at our sectors now. Chart 5C. Now, I did change this. This was not one of the major changes I did over the weekend in the charts, but I did rearrange a couple of things. I did put technology, communications, and discretionary on the top line here, and I moved financials into that middle rung. The way I kind of think about these different sectors is the top three up there are growth oriented. You've heard me refer to those as like growth compounders. The middle area is what I think of as cyclical, right? It requires a strong economy for the stocks in those areas to be doing well. And then the bottom rung is the defensives. Those are the ones that tend to do a little bit better when the rest of the stock market and economy is struggling, at least on a relative basis. So anyway, just didn't want that to confuse you. If you're used to seeing financials, it used to be on the top rung, but I've moved them to the second rung, and I moved discretionary up. Not a big deal, but just in case you thought something looked a little bit different, I wanted to at least verbalize that here to make you aware of that. But that was not a major change, just a repositioning. What I did with the charts, which ones were they? The charts 1E, 1F, 1G, and 1H, those were much more than just rearranging. Those will be required for those of you that attend my Monday morning class to do the updates. It's not just something simple like repositioning one ticker symbol in another area. It required kind of reconstructing the actual think scripts themselves. And so again, remember when you're reading these chart labels, you'll see when we updated it last. So in this case, the updates were done on June 18th with those 4 charts right there. So again, if you're a premium member, make sure you check that out. Remember, you can find that on our premium tools area of our website if you're looking for those shared links. Anyway, let's see what we can learn here from our sectors today. As mentioned when we were going through the heat map, I said I wouldn't be surprised if energy was the worst one today. Indeed, that was the case. Energy had a terrible day. It was down over 3% today, and you can see what that looks like on the chart here. Energy is now joining utilities as the only 2 bearish charts on the board, although energy is weakly bearish, whereas utilities are strongly bearish. But that's not a great look right there, breaking cleanly below the moving average, so aggressively, in fact, that it changed the moving average from going up to going down in a single one fell swoop. A lot of times there's more of a transition yellow period in between the green and the red, but if the candle is aggressive enough, as it was today, you can change and pivot very, very quickly. So all of a sudden, energy chart is not looking particularly good. So that was the worst performer today. The best performer was discretionary, and that is likely as a result of Tesla, right? Again, Tesla had a very nice day here today, has been on a tremendous run in general lately. If you want to see what that Tesla chart looks like, here's the Tesla chart. I mean, it is basically straight up. It is unbelievable, especially when you're talking about the hundreds of billions of dollars in market cap associated with that company. So Tesla kind of saved the day there for XLY. Remember, Tesla and Amazon are the most important companies in XLY by a long shot. And so they did manage to close up by 0.55% today across the discretionary sector. That was the only one that managed to close in the green. As I mentioned before, utilities also strongly bearish at the moment. All the rest of the charts are bullish in terms of the ones that look the best. I would say it's those that are on the top rung. Technology, communications, discretionary are the ones that seem to look the best. The ones that look the worst, probably staples and utilities, right? The two dead last ones on the sector selector that I'd mentioned before, both of those are rejecting the falling moving averages here at the moment. You could also throw energy into that conversation on an honorable mention capacity there. All right, let's go ahead and get into the trade application example now. Just pull up a swing trading chart here. And the stock I wanted to bring up was Qualcomm. This is one of the rare tech stocks that's not been really lighting the world on fire. It's not really, doing poorly, but it's just not, roaring to the upside the way that we see with, one of its competitors within the semiconductor area, like NVIDIA as just one example, or Broadcom, right? If you were to look at Broadcom, that's what that looks like. If you want to look at NVIDIA, that's what that looks like, right? And I could go on. There's a lot more of them that look like that, but notice how Qualcomm doesn't really look like those two nearly as much. In fact, Qualcomm, even on this pretty impressive run from 101 here on May 25th, up here to about 125 on June 13th, did not eclipse where its high was in the 3-month chart. That still is held here by where you see this high tag over here on March 30th. So remember, most other tech stocks have gone well beyond that. If you just look at XLK, the ETF that tracks the tech sector, look at how far away the high was on just Friday compared to May 30th on the tech sector in general, right? Here's May 30th on the tech sector, and here's where it was over here. Yet you look at Qualcomm, and you still had a higher print on May 30th, or I'm sorry, March 30th. Sorry if I'm confusing you. I'm confusing myself. Sometimes I'm looking at these dates too quickly. March 30th, and we did not eclipse that on this most recent move here. So it looks like there's some people hesitating, thinking twice about this big move off the low, but not ready for prime time to actually push through these new highs yet. Notice that today we closed well below where we've been trading the last 4 days or so. It kind of gives you the impression that it's kind of rounding the corner back to the downside once again. Notice that it has been underperforming the S&P 500 over the last 3 months as well. You have this pink background color of the chart telling us that the near-term line is out of favor. You do have a rising 30-day moving average still, so that might be a little bit of a fly in the ointment here, but remember, no trade is perfect. By the way, last time I was with you on Thursday, I did that short trade on Disney, and wouldn't you know, we got that sucker locked down at max gain the very next day. Remember, when we go to max gain in one day, I refer to it as hitting the old easy button, so that was nice. Doesn't happen a lot, but when it does, we're thankful for it. And so for those of you that took that short trade on Disney from my Thursday video, congratulations. That was a quick and easy profit for us. So will this one be quick and easy? No, because what I ended up doing here was different than the Disney one. They're both bearish trades, but in this case, instead of just shorting the stock, what I ultimately did was I sold a bear call spread. So when I'm doing that, I'm basically selling one call strike and I'm buying another, which is creating a credit that I receive up front. And as long as the stock stays below my break even, I am going to have a decent chance of winning that trade. And what we usually shoot for with these types of trade setups is a 30% return on risk, and that's pretty much exactly what I got today. A little bit better than that, actually, because on a dollar wide, you want to get at least 24 cents of credit for a 30% return on risk. Today, I actually got 25 when I sold this one. And you can see that I sold the 127 strike. I received 25 cents worth of credit, and I bought the 128. So my break even here is at 127.25. You can see that that break even with that black line, and you track it backwards, will take you right across the highs of that prior resistance area back here at the end of March that I referenced before. You also have a little bit of a bearish near-term divergence. This is not a great example, so don't look at this as a textbook example or anything, but it is still there to a degree. You have a peak in the blue line right here on May 30th. You have a follow-up peak here on June 13th, and to the naked eye, that does not look like it's a lower high, but if you look at the actual numbers, it is by the smallest of margins. On this particular day, the blue line ended at 92.99. On this day, it ended at 92.91. So you could probably get away with saying it's an equal high there. But regardless, the idea is you had at least some deterioration here in the underlying indicator. When you're looking at the candle associated with those two levels, it would be this one and then this one. So from here to here is an obvious higher move in price, but down below here you had a slight deterioration in the indicator. Sometimes that can add to the bearishness that we have on the trade up there as well. So that's what I did, a bear call spread on Qualcomm. I used the July monthly contracts. Remember, those of you that are premium members, these trades are done while the stock market is open. We send out the execution details to you in our private Telegram channel. So if you needed to verify the strike prices or the execution prices or anything like that, you can always check that Telegram channel. Okay, that's what I had for you here tonight. Pretty bearish day for the market, but of course, having had such a bullish move here in recent weeks and months, we can afford to have some of these give back days and not feel too badly about it. But without a doubt, more selling than buying here today. Remember that Jerome Powell will be speaking here tomorrow, so could be a little bit of hiccups as a result of that. But for the most part, we do continue to have bullish trends on most of our internals and new highs, new lows, trends, all sector rotation, all that kind of stuff still is leading towards more bullishness than bearishness, despite today's give back. So hope you enjoyed that presentation. If you did, I ask one simple request out of you. Simply click like for me there on Twitter. As long as we're up and over 100 likes, I'll plan on doing another full-length video for you on Thursday. On the other hand, if you just want a short and sweet one, don't click like. And if we're under 100 likes, then I'll just keep it to a 15-minute maximum there on Thursday. So we'll let you guys decide collectively. Whatever you do decide, I appreciate you checking out tonight's video, and I hope you have a great rest of the evening. Take care, everybody. Bye-bye.